What if I told you that you could save tens of thousands of dollars on your mortgage, but only if you know one simple trick? And here's the catch. Sometimes this money-saving trick backfires and ends up costing you more. That trick is mortgage refinancing. Today, we're diving deep into the question, is mortgage refinancing worth it? By the end, you'll know exactly when it makes sense, when it doesn't, and how to avoid the traps most beginners fall into. Number 1. What is refinancing really? Think of refinancing like trading in your old car for a new one. Except here, you're swapping your current mortgage for a brand new one, usually with a different interest rate or loan length. For example, let's say you bought your home with a 30-year mortgage at 6% interest. A few years later, interest rates drop to 4%. If you refinance, you're basically replacing that expensive loan with a cheaper one. Sounds simple, right? But there's more to it. Just like trading cars, refinancing comes with costs, paperwork, and timing issues. Number 2. The main reasons people refinance. Most homeowners refinance for one of 4 reasons. First, to get a lower interest rate. This is the big one. A lower rate means smaller monthly payments and less interest over the life of your loan. Second, to change the loan term. For example, moving from a 30-year mortgage to a 15-year one. That shortens your payoff timeline but makes monthly payments higher. Third, to switch from an adjustable rate mortgage to a fixed rate one. Many people do this for stability when interest rates are climbing. And fourth, to tap into home equity. This is called a cash-out refinance. Imagine your home has gone up in value and you've built equity. A cash-out refi lets you pull some of that money out like a big piggy bank to use for renovations, debt payoff, or even investments. Number 3. The hidden cost you cannot ignore. Refinancing isn't free. Lenders love to advertise the shiny new rate, but they often whisper about the closing costs. Closing costs typically run between 2% and 6% of the loan amount. On a $200,000 loan, that's anywhere from $400 to $12,000. So even if you're dropping your interest rate, you need to calculate whether the savings outweigh the upfront costs. Here's an example. Say refinancing saves you $200 per month, but your closing costs are $6,000. That means it'll take you 30 months or 2.5 years just to break even. If you plan to move before then, refinancing might actually lose you money. Number 4. When refinancing saves you a fortune. Here's where it gets exciting. If you lock in a much lower rate and plan to stay in your home long term, refinancing can literally save you tens of thousands of dollars. Imagine you owe $250,000 on a 30-year loan at 6%. Your monthly principal and interest is about $1,500. If you refinance to 4%, your payment drops to around $1,200. That's $300 saved every month. Over 30 years, that's more than $100,000 in savings. That's like paying off a college tuition or buying a luxury car, just from one decision. Number 5. When refinancing is a terrible idea. Here's the flip side. Refinancing is not always the golden ticket. It's usually a bad move if you're planning to sell your home soon. Why pay thousands in closing costs if you won't live there long enough to benefit? It's also risky if you're refinancing into a longer loan term. For example, if you've already paid 10 years on your 30-year mortgage and refinance back into a brand new 30-year loan, you're stretching out your debt another 3 decades. Sure, your monthly payment goes down, but the extra years of interest could mean you're paying more overall. Another trap? Cash out refinancing to splurge. If you refinance just to fund a vacation or buy gadgets, you're trading home equity for debt. That can be dangerous. Number 6. The break-even point you must know. Here's the number 1 calculation that determines if refinancing makes sense. The break-even point. The break-even point is how long it takes for your monthly savings to cover the closing costs. Example. If your closing costs are $5,000 and you save $250 a month, your break-even point is 20 months. If you're staying in the home longer than that, refinancing could be smart. Shorter than that, you're likely losing money. Knowing your break-even point is like having a crystal ball for refinancing decisions. Number 7. The credit score factor. Your credit score is like your VIP ticket to better mortgage rates. The higher it is, the better your refinancing deal will be. If your score is in the mid-600s, you might qualify, but the rate won't be amazing. Push your score into the 700s or higher, and suddenly lenders roll out the red carpet with much lower rates. So before you even apply, it might pay to work on your credit. That could mean paying down debts, correcting errors on your credit report, or simply waiting a few months until your score improves. Number 8. Income and job stability matter. Lenders want proof that you can repay your mortgage. If your income is steady and your job history is solid, refinancing is easier. But if you've just switched jobs or your income is inconsistent, lenders may hesitate. That's why many people choose to refinance after a promotion or when their household income rises. Number 9. Cash out refinance. Good or bad? Cash out refinancing deserves its own spotlight. Here's how it works. Suppose your house is worth $300,000 and you owe $200,000. That means you have $100,000 in equity. With a cash-out refinance, you could refinance into a new $250,000 loan, pay off the old $200,000 and pocket $50,000 in cash. Sounds great, right? But here's the catch. You're increasing your loan balance and possibly your monthly payment. It can be smart if you're using that cash to improve your home, which could raise its value, or if you're consolidating high-interest debt. But if it's just for lifestyle spending, you're basically borrowing against your house to fund short-term wants. That's risky. Number 10. The timing of interest rates. Interest rates move like the tides. Sometimes they're low, sometimes they spike. The best time to refinance is usually when rates are significantly lower than your current rate. Experts often suggest refinancing if you can drop your interest rate by at least 1%. But here's the catch. Rates can change quickly. For example, in 2020 during the pandemic, rates hit historic lows. Homeowners who refinanced then are sitting pretty. Those who hesitated missed the boat. So timing matters. Watching the market can save or cost you thousands. Number 11. Refinancing myths busted. There are a lot of myths out there. Let's bust a few. Myth 1. Refinancing always saves money. False. Sometimes the costs outweigh the savings. Myth 2. You can refinance as many times as you want with no downside. Wrong. Each refinance resets your loan term and comes with costs. Myth 3. Refinancing hurts your credit forever. Not true. It can cause a small dip in your score short term, but if it lowers your payments and helps you stay on track, it could help long term. Number 12. Alternatives to refinancing. What if refinancing doesn't make sense for you? You're not stuck. One option is making extra payments on your current mortgage. Even an extra $100 a month can shave years off your loan. Another option is recasting your mortgage. This is where you make a big lump sum payment to reduce your balance, and your lender recalculates your payments lower, without the closing costs of refinancing. Sometimes, just negotiating with your current lender can help too. Number 13. Real-life example you can learn from. Let's look at two families. The Smiths refinanced their $250,000 mortgage from 6% to 4%, saving $300 a month. They stayed in their home for 15 years and saved over $50,000 after closing costs. The Johnsons refinanced into a cash-out loan, took $40,000, and used it for vacations and a new car. 10 years later, they still owed more on their home than the Smiths, and most of the money was long gone. Two choices, two very different outcomes. Number 14. How your home's value impacts refinancing. Your home's current market value plays a huge role in refinancing. Lenders look at something called the loan-to-value ratio, which compares how much you owe on the house to what it's worth. If your home's value has gone up, you may qualify for better terms. For example, if you originally bought your home for $200,000 and now it's worth $250,000, your loan-to-value ratio improves, making lenders more comfortable giving you a lower rate. But if your home has dropped in value, refinancing can be tough. Number 15. The role of private mortgage insurance. If you put down less than 20% when you first bought your house, you probably had to pay private mortgage insurance, also known as PMI. Refinancing can sometimes help you eliminate PMI if your home value has increased enough and your new loan is under 80% of the home's value. That could save you hundreds of dollars a month. For example, if you're paying $150 every month in PMI and refinancing gets rid of it, that's an extra $1,800 saved every year. Number 16. Government-backed refinance programs. If you have certain types of loans, you might qualify for special refinancing programs. For example, the FHA Streamline Refinance helps people with FHA loans reduce their payments with less paperwork. VA loans also offer an interest rate reduction refinance loan, or IRRL, which makes it easier and cheaper for veterans to refinance. These programs often have reduced fees and simpler requirements, making them beginner-friendly. Number 17. The impact of refinancing on taxes. Refinancing can affect your taxes in subtle ways. For instance, the interest you pay on your mortgage is usually tax-deductible, but if your monthly interest goes down, your deduction may shrink too. If you take cash out during a refinance and use it for non-home improvements, that interest might not be deductible at all. So while saving on interest is great, it's worth understanding how it changes your tax situation. Number 18. Refinancing with bad credit. It's not impossible to refinance with bad credit, but it is more expensive. Lenders may still approve you, but the interest rate won't be as low as someone with a higher credit score. For example, if you have a score of 620, you might only qualify for 6%, while someone with a 740 score could get 4%. That difference can mean thousands of dollars over time. In some cases, it may be smarter to wait. Work on boosting your credit score and then refinance later for a better deal. Number 19. The paperwork and process timeline. Many beginners underestimate the process. Refinancing isn't done overnight. It usually takes 30 to 45 days, depending on the lender. You'll need to provide tax returns, pay stubs, bank statements, and proof of insurance. An appraisal is often required too, which means someone comes to check your home's value. Knowing the timeline helps set realistic expectations and prevents frustration. Number 20. Refinancing investment properties. Did you know? Refinancing isn't just for your primary home. You can refinance investment properties too. But lenders usually charge higher rates and require more equity for those. For example, while you might refinance your primary home with only 20% equity, an investment property might require 25 or 30% equity. Still, for landlords, refinancing can free up cash for new properties or lower monthly costs, improving cash flow. At the end of the day, refinancing is a tool. Like a hammer, it can build or it can break, depending on how you use it. So, is mortgage refinancing worth it? The truth is, it depends on your goals, your timeline, and your numbers. Run the math. Understand the break-even point. Think long-term. Now I want to hear from you. If interest rates drop tomorrow, would you refinance your mortgage, or would you stick with what you have?